Welcome back to Learn SKN, and today we're going to be looking at Module 3, Section C of the Mayjune 2013 CAPE MOB Paper 2 for Unit 1. We're going to be looking at, we're going to continue this paper. We did up to question 4 in previous videos, and so we're on to question 5. And question 5 comes from the Module 3, the Business, Finance and Accounting module. And so we start out this question. Sugar Producers Limited, a small business engaged in sugar cultivation, is experiencing cash flow management problems. The table shows the budgeted and actual results for sugary producers overheads. So we have the Sugary Producers Limited, we have the production, you have a budget of 300,000, the actual was 240,000. Human resource, the budget was 120,000, the actual was 140,000. Marketing was 480,000, the actual was 560,000. So right now you can see what is going on here. And so question 1 in A asks you to define the term variance. And so variance is simply the difference. So when we speak of variance in budgetary control, this refers to the fact that at times there is a difference between the actual results and the budgeted figures of the firm. So you get that by minusing, but you have actual minus the budgeted. And so that's what the definition of a variance is. It's the difference between the amount that the firm budgeted versus what they actually had to spend. And so you get that by taking away the actual from the budgeted. That's what you call the variance. Right there we have that definition out the way, 2 easy marks. And then it said calculate the variance for each department at Sugary Producers Limited. A very same way, very simple. This is the actual, and you have to minus the actual from the budgeted. So you minus this from that to get the variance. Alright, so it's basically you're minusing column 2, well 1 to 3, well column 3 from column 2 to get the correct answer. And so let's just quickly do some maths with the calculator. And so the first one we have 240,000, and we minus that from the 300,000, and we get a difference of 60,000. So the variance for this one for the production is 60,000, right? So the variance for that one is negative, I must say, negative 60,000. In this case, we're just looking at the more important numbers. All right, so one thing we're gonna see that the actual cost here is lower than the budgeted cost. So the actual cost is lower than the budgeted cost. Is that a good thing or a bad thing? That's what the next question is going to be asking us. So we have 60,000 right here. And then for the other one, it's 140,000. So it's 140 minus 120, and we get 20,000, right? We get 20,000 right there. So we get 20,000 for this one. It's a positive 20,000. It's a positive 20,000. And so that means that the actual is higher than the budgeted. All right, and the last one now for marketing, 560,000 minus the 480,000. 480, and we get 80, right? We get a positive 80. Again, the budgeted is less than the actual, or the actual is more than the budgeted. So for 2 of these, we are seeing that the actual, which is human resource and marketing, is higher than what was initially budgeted. So we have some problems here. So we can see here that you can see the variance calculated here. So all you have to do is subtract the actual from the budgeted, and you get your variance here. So that's your 2 marks. And it's a calculated variance, so that's 3 marks, sorry. Then number 3 said, state what each variance calculated in A to above indicates about the performance of the company. state what each variance calculated in A to above indicate about the performance of the company. And so we look at what them one by one. So here we have production, and the overhead for production is actually lower than anticipated. So it's lower, the cost is lower than what was budgeted. And so in my book, that's favorable or positive variance. Why we say that? Because again, the actual is lower than the budgeted. Now as it relates to production, this could simply mean that the cost of inputs gone down, and so therefore production for cost goes down. It can also mean that the workers are more efficient, and so they use less and make more or the same. So efficiency gone up, our cost of production gone down. Then you have human resource, so that your workers. So you budgeted for 120,000, the actual is 140,000, and the variance is unfavorable or adverse. Now, as it relates to this, one of the reasons could be the fact that the company budgeted poorly. All of them, right? All of them could mean that the company budgeted poorly. That could be a reason. And so if that happens, then you know they need to improve that. But as it relates to human resource, it might mean that they had to increase over time, hire more persons, things like that, or it simply means that they are poorly budgeted, or for some reason there was a wage increase or cost of labor went up, and so unforeseen events. Marketing, same thing. It's adverse because the actual cost is higher than the budgeted, and so marketing went over budget. So it could mean some levels of inefficiencies. It could mean that they saw something unforeseen. For these are some reasons why why we have variances. Poor budgeting. This is where management makes impractical and ill-advised estimates, resulting in cost overruns. Change in the price of inputs, as we said before. This could result in a higher than budgeted cost or lower in some cases. Unpredictable events such as natural disasters can halt production, causing variance in sales and production. Improper recording of data, costs, or revenue could misrepresent the accounts. And so all those are reasons that could account for the variance in the budget versus the actual. So you can see what they are, so you can say which is adverse from which is favorable, and you can give a reason as to why each might be so. B. Define the term budget. What is a budget? And so from the textbook it says, a budget is a financial plan or statement which shows specific objectives or targets that a business hopes to achieve over a given period of time. So that's the textbook definition of a budget. So it's a financial plan or statement which shows specific objectives or targets that a business hopes to achieve over a given period of time. Alright, it's a financial plan that shows the inflows and outflows of money, of capital, anything like that. That's a budget. It's a projection. So but first and foremost, it's a financial plan or a statement, right? So that's a simple definition for a budget. So with that, you get 2 marks. State 3 reasons why it is important for sugary producers to construct a budget. So why is a budget important? So we say they have a whole list here, right? Budgets help you to set targets and business objectives. That's one. Budgets can indicate possible future stumbling blocks such as shortage of resources. That's 2. Allows the firm to identify and assess alternative courses of action. That's 3. Monitor performance of the business over time. 4. Enable the firm to allocate resources effectively. 5 and 6. By setting realistic targets, employees could become more committed to the business and its objectives. So all these are reasons why, textbook reasons why budgeting is important, and that's what they ask us here for. State 3 reasons why it is important for sugary to construct a budget. And so these are all reasons why it's important. Advantage of budgeting. So it acts as a guide for managers in the achievement of business objective, as we say here. So it set the target and objectives. Fosters communication and coordination within the organization. allows for proper employment of capital when matched against the planned level of activity. So here what they say here, enables the firm to allocate resources effectively and provides control for income and expenditure, thus minimizing inefficiency and wastage. All those are the reasons why budgeting is important, some benefits of budgeting. The last question under this one, discuss 3 options that can be considered in order to improve the company's cash flow management. So let's jump to the textbook and see what we can find as it relates to cash flow. All right, so possible solutions for a cash shortfall. So clearly we see that there's an issue with cash because they said to improve it. Right? So they said to improve the company's cash flow management, so therefore something's amiss with the cash flow. And so we look at possible solutions for a cash flow, for a cash shortfall. So here we go. Raising cash from a new issue of shares. If you're a company, you can always issue new shares to raise some more cash in order to have it on hand, so that you don't have a negative impact from the lack of cash flow. So apart from just raising cash from new issues of shares, you can also go and get maybe a loan, a quick loan, a business loan, something like that, to help you bolster your cash that you have on hand so you can meet your obligations. So here what it says: switch its debt from short-term to long-term debt. So the company can choose to switch its debt from short-term to long-term. And so normally when you switch from short-term to long-term, sometimes the monthly payments would be less. And so this would help to keep more money, more cash in the business itself, keep the business a little more liquid. So you can switch from a short-term where you have to pay back high interest rate, or you could have to pay back higher installments, to maybe a longer term debt where you pay a smaller portion over a longer period of time. Also, that would give you a larger amount, that might give you a larger amount of cash infusion, because long-term debts tend to be a lot larger than the short-term debts. So you might have money for a longer period of time that you can use to help stabilize the cash flow in the company. Then you have reducing capital expenditure. That's obvious. If you want to have more cash on hand, you want to have more cash inflows than outflows, you just reduce the spending. You cut down the expenditure. So you see where the company can cut some of its spending. You're looking at production, human resource, marketing. Maybe they can cut some spending on marketing and maybe on human resource. Sad, but they might have to lay off some persons. That could help to cut the cost of overall production. And so that's the next way to improve cash flow management. And then you have tightening credit to its debtors while delaying payments to its creditors. What does this mean now? Now sometimes companies would sell things on credit, right? So a lot of wholesale companies, they would sell things to the small supermarkets or whatever on credit. And then they might have a certain amount of time in which the persons that they sold the items to have to repay them. Some have a 30-day, 90-day, 120-day, whatever their system is. But sometimes it may be too long. And so you don't get the cash inflow in time to keep the company nice and liquid. So what you have to do now is shorten that period of time that people owe you. So one way you can do that is go and make sure I'm not going to say run them down for your money, but make sure you incentivize them to pay quicker. One way you can do this is by offering discounts for persons who pay fast. You pay a little, you pay faster than you're supposed to. You offer some discount. Another way you can do this is by charging a late fee. Company charge a late fee, and people might be incentivized to pay faster. So you tighten that. Also, you can delay the payment to your creditors. You don't have to pay them one time all the time. Sometimes you could, hold it back a week or two until certain funds come in, and then you can, have that cash outflow once the inflows are in. So you can pull back on paying your creditors, and also basically go and get your money from persons. Don't have them having it too long. So those are ways you can improve cash flow. Then of course, disposing of non-productive assets. If you have a lot of stuff lying around, inventory and things like that is not useful to you anymore, of course you can sell them, get them off your books. You can earn some money in return. and so you can get that money to infuse it back into the business. So all these are ways you can increase your cash flow into your business. Or as the question says here, state options that can be considered in order to improve the company's cash flow management. So all these are things you have to do to improve your cash flow management. Of course, another thing you can do to manage your cash flow properly is, of course, create a cash flow statement. A cash flow statement showing how inflows were generated and outflows were spent. A cash flow statement shows the movement of cash into and out of the business. So you create a cash flow statement so you can know exactly where money is going, where it's coming from. Where money is going, where it's coming from. So that's the next you can use to manage your cash flow. Another way, of course, is to use technology, right? You can use technology. You can use maybe some QuickBooks or whatever. So, but use some kind of inventory management system, some cash management system. So use technology so you can precisely predict, what is happening. It can tell you when receipts are due, when invoices are due, and those kind of things. So you can use technology, use nice software so that you know who owe you, who you owe, what the schedule is for repayment, things like that. All right, so those are some things that we have outlined that shows how you can improve the cash flow management in this company. And of course, it's 12 marks. So you have 3 options, so 4 marks each. So you drop one, you explain it. For example, you may want to say, switch from short-term to long-term debt. So you can go to a bank for a larger loan, a business loan, so they can use that loan in order to cover some of your financing, some of your capital needs. You can use it for that. So you have to expound on exactly what we just discussed. And once you would have done that, then you know that you're writing your 4 marks for each one, and you would have completed this question 5 on the MOB 2013 Unit 1 Paper 2 question 5. You complete it, right? That would be 25 marks total. All right, so that's it for this question. The next question we're going to do to finish off this paper is question 6. So you have to stay tuned for that one. But only how you know when Learn SKN drops question 6 is by, of course, subscribing and hitting the notification bell. So do those 2 things and we're good to go. All right, thanks for watching. Thanks for listening.